Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one of the UK-focused, actively managed collectives that sits within our new list of 72 favourite funds, namely Evenlode Income. The fund's mandate is to provide long-term total returns for advisors and clients with an emphasis on income. It seeks to deliver this by building a concentrated portfolio of predominantly UK stocks, although there can be some overseas picks as well. The lead managers are Ben Peters and Hugh Yarrow, the latter having set up Evenlode back in 2009. They tend to focus on stocks capable of delivering sustainable growth with limited need for additional capital investment. Such scalable business models can mean there's plenty of cash left over once bills are paid, and that cash flow can ultimately be turned into dividends for the funds managed on behalf of advisors and clients. According to the latest fact sheet, 82% of the assets are held within the UK, with 15% in the US and the rest in Europe, as we can see here. The biggest individual holding in the £1.3 billion fund is consumer goods giant Unilever, which is particularly topical as the FTSE 100 firm has just announced a new 6-point plan designed to boost returns for shareholders following the fright it received in the form of a tentative bid approach from American company Kraft Heinz. After Unilever, the biggest positions are global drinks player Diageo, pharmaceutical firm GlaxoSmithKline, American software behemoth Microsoft, and then FTSE 100 accounting software specialist Sage. The other big US holdings in the top 10 are health and hygiene player Johnson & Johnson and personal care firm Procter & Gamble. The net result of all of this is a tight-knit portfolio of just 39 holdings, where the largest sector exposures are consumer staples, tech and healthcare. Interestingly, real estate, telecom, utilities and energy, all sources of income for many fund managers, have no presence at all in Evenlode Income, as we can see here. Large caps currently represent just over 60% of the assets, mid caps just over a quarter, and small and mid caps the rest. The overall result of Peters and Yarrow's approach is a fund with a Sharpe ratio of 1.3 and a beta of just 0.86 over the last 3 years. The fund is eligible for SIPs, ISAs and dealing accounts and currently comes with a yield of 3.2%. Dividends are paid quarterly. The ongoing charge figure is 0.95%, and for those who set store by such things, the fund comes with a 5-star ranking from Morningstar. So, those are the mechanics. The question to address next is, could advisors and clients consider this collective for portfolio inclusion today? Well, if so, I think there may be 3 possible reasons. The first is that 3.2% yield, which still handily outstrips anything available on cash, any UK government bond even out to 50 years, any US government bond, and any 10-year bond from a Eurozone nation, except for those issued by Portugal and Greece. The second is the portfolio's makeup. Stable and able consumer defensives fell out of fashion in the second half of 2016 as the UK referendum and US presidential election results prompted a dash for the reflation trade, amid hopes for accelerating economic growth and inflation. Trump's failure to push through healthcare reform, the risk of delays to tax reform, and the absence of big infrastructure plans from the budget blueprint all question the reflation theme, as does a slight ebbing in UK and US inflation figures. Any further such doubts could stoke fresh interest in the more dependable earnings streams on offer from portfolios such as this one. Thirdly, we'll come to historic performance. While we must all accept this is no guarantee for the future, Evenlode Income has built a good track record since inception in 2000, with fairly limited volatility, as evidenced by that 3-year beta, which is very low, and also this final chart here. Now, this combination may appeal to advisors and clients who are feeling a little nervous about short-term market conditions or are seeking a long-term holding to help form the bedrock of a portfolio's income element. Now, none of this is to say Evenlode Income may suit every advisor and client's overall strategy, target returns, time horizon, or appetite for risk. There are certainly income funds out there which come with a higher yield, and passively run income funds may well come with lower costs. In addition, the focus on the UK may not appeal to everyone, given the doubts which may persist in the minds of some still about Brexit and now the snap election called by Prime Minister Theresa May for June the 8th. Now, this fund hasn't been tested by a bear market yet, and there are always risks, whether they relate to the broader UK stock market or more specifically to the managers and their process. As a result, advisors and clients should do their research before deciding whether to put any capital to work or not. Thank you for watching, and I look forward to seeing you next time.